We are going to take a look at a individual tax filer scenario under the old tax code, Tax Cuts and Jobs Act, compared to current tax code that was signed into law on July 4th as part of the One Big Beautiful Bill Act. Our scenario one is the old code. Scenario two is our new code. Wages for this individual are 179,000. That's a net number, so that is after retirement plan contributions, pre-tax health insurance, those kinds of items. We have tax exempt as well as taxable interest. We have dividends, and this person also has capital gains. Total income as well as adjusted gross income are the same in both of our scenarios. So our objective is to isolate this and look at just what changed. And our column in the middle will show us what changed between our two scenarios. And that actually happens in our next area we're going to look at. So under Schedule A, itemized deductions, you'll see that this individual has state and local taxes. They have state and local real estate taxes. They have personal property taxes. So our total state and local taxes in both scenarios are $16,305. Again, state and local income tax, state and local real estate tax, and state and local personal property taxes. What you can see the difference between the two is under old code, we were capped at 10,000. That cap is removed under the new code, and there's an additional 6,300 of deductible state and local taxes for this person. They also have mortgage interest and a little bit of charity. So our total itemized deductions were $28,750 under old code. They're now $35,055 under the new code. So we have an increase of $6,305 in deductible state and local taxes, which impacts our itemized deductions. What's also interesting about this situation is because taxable income goes down, as we increase our deductions, our taxable income comes down, we also pick up an additional $400 in child tax credit. So because that taxable income figure is higher, this person captures more of the child tax credit. And as we go to the bottom line, you can see that our total tax bill decreases by about $1,900. So we have $1,900 less paid in federal taxes. That also means in the state of Georgia, in our situation, we have an additional $300 of state income tax savings. So that $2,200 can be used for Roth conversions, contributions to retirement plans or Roths or 529s. All of that is now available for other financial goals. To take a little bit of a deeper dive on the Schedule A, you can see state and local taxes at 16, mortgage interest at 13,750, 5,000 in charity. So our total itemized deductions are 35,000. And when we look at this bar chart over here, here's our different areas of itemization. Our standard deduction is 15,750. Well, just because of the increase in the SALT cap, this person has more than enough to itemize even without including the mortgage interest and the charity. So this impact was pretty substantial for them. It makes it so all of the charity is deductible as well as mortgage interest. We are going to take a look at the SALT impact with the changes in the One Big Beautiful Bill tax law that was signed back on July 4th of 2025. Scenario one is our old tax code with the Tax Cuts and Jobs Act. Scenario two is our current law under the OBBBA tax laws. Our income is going to be the same. So our objective was to keep that the exact same, to take a look at the changes that come with SALT. So our wages are going to be net of pre-tax items, so retirement plan contributions, health insurance, those types of things. We have taxable interest, we have dividends, and this situation also has capital gains. What that adds up to is total income of 441, as well as adjusted gross income of 441. So you'll see those are the same in both of our scenarios. This middle column will show us our changes, and we're about to see where the impact comes in. So on our itemized deductions, we can see that our state and local income taxes, our real estate taxes, and our personal property taxes are the same in both scenarios, which means our total state and local tax is $29,985 in both scenarios. But under old tax code, we were only able to take 10,000 of that deduction because we were capped. For this situation, the full $29,985 is able to be deducted, which is this increase of $19,985. This situation is mortgage interest. We also have charity. So when we get down to the standard versus itemized deduction category, we can see that under old tax code, we would have been at the standard deduction of $30,000. Now we're able to itemize because of the increased SALT deduction. Interestingly, for this situation, because our taxable income goes down from 411 to 392,000, this person is receiving an increased child tax credit. So our child tax credit actually increases because taxable income is lower. So that's a multiplying effect of the different SALT cap change. When we look at the total tax liability, in this situation federally, our tax bill dropped by just under $4,900 on federal taxes. And then for the state, and in this situation, we're using Georgia, we had about $1,900 in savings. That additional $6,800 roughly in tax savings can be used for a variety of different financial planning needs, objectives, and goals. We could increase retirement plan contributions. We could Roth convert. We can put more money into 529 plans. We can continue to build up a bigger cash reserve or second tier cash reserve. All of those things are available, but really there was nothing that changed in this situation, simply that the tax code is different as written under current law.